Since March of 2020, the Turkish stock market has risen by 1,000%. That means it went up 11-fold, rising 6 times more than the S&P 500 did during that same time period. The Argentinian stock market managed to return a staggering 3,500% over the course of those 4 years, a 36-fold increase. This didn't happen because the Argentinian economy was booming. Quite the contrary, it happened because the Argentine peso has been in total collapse, losing 84% of its value relative to the US dollar, and recently being devalued again by 50%. Any Argentinian holding the peso has been seeing their purchasing power get eroded in real time, and many believe this could be something that we can also witness in the United States with the US stock market, a reverse stock market crash as they call it. And it's a fair question given the stock market has been melting up recently, yielding similar results to what we've seen in 2009 and in 2020, as the Federal Reserve has just announced that they will be bringing interest rates back down in 2024. Unlike Turkey and Argentina, the dollar has been very strong. Yes, we have seen a little bit of a weakness in the US dollar since the Federal Reserve has announced that they would be reducing interest rates, but when looking at the broader trend of the US dollar index, it has been moving higher over the last 15 years, so we're not seeing a currency collapse in the United States, right? The problem there is with looking at the US dollar index is that it's just a measure of the exchange rate for the US dollar against other currencies around the world. It measures how many dollars you need to buy a basket of other currencies like the euro, the Chinese renminbi, the Japanese yen. It doesn't tell you if all of these currencies are actually sinking together. If all of the currencies in the basket are losing purchasing power together, the US dollar can remain elevated relative to those currencies, but when comparing to things that hold their value like gold, homes, businesses, that's when you can actually observe if many currencies are sinking together. And this is a phenomenon we've actually experienced to some extent throughout the last 50 years. The S&P 500 has returned a staggering 5,000% since 1970. That's a 51-fold increase. But when we look at the S&P 500 return adjusted for inflation, it's a mere 500%, so a 6-fold increase since 1970. That's 7 times less than if you don't adjust it for inflation. So when we remove the component of currency debasement from the equation, the stock market's rise over the last 50 years looks a lot less impressive. Stocks protect you against this erosion of purchasing power because these are businesses that produce and sell the very goods that are rising in price. If the price of the raw materials are rising because of inflation, the businesses will just raise their prices to keep their profit margins. So the revenues of businesses naturally grow in line with inflation, and so the S&P 500 naturally moves higher as the purchasing power of the US dollar sinks. This is true for every single stock market around the world, including Argentina and Turkey. But unlike those countries, the US dollar's exchange rate relative to other currencies hasn't moved over the last 50 years. Yes, we've seen some large moves up and down, but over time it's actually sitting at the exact same level that it was in the early 1970s, and that gives you a false impression that the US dollar has actually retained its value since then, when in reality it has been sinking relative to the price of most things. Food, housing, oil, gold. This is by how much the price of these things have risen since 1970. These are very impressive numbers. In some ways, modern financial history has been nothing but a big reverse market crash. The real question we should be asking is whether this trend is going to continue into the future or even get worse and accelerate. In order to find out, we need to look at something called the money supply. This is the total number of dollars that are in the financial system. Over the long run, this gradual increase in the money supply is what causes the price of everything to rise. You can imagine that a house is more expensive at a moment when there's $30 trillion circulating in the financial system than when there's only $500 billion, which was the case in 1970. And that can also be applied to the stock market that gradually rises in line with the money supply. In fact, since 1970, both the money supply and the stock market have risen by around 5,000%. What a coincidence. So theoretically, that does mean that the stock market will go up forever, unless we see a complete collapse of the financial system, and so we'll continue to see the stock market move higher over the long run. But the money supply has actually been going down recently, and yet the stock market has been rising. One possible explanation for that is that the stock market is already anticipating that the money supply will be turning higher with this recent announcement from the Federal Reserve. For example, in 2020, the money supply went up by 30% and the stock market basically went up by 30% as well. So is it that simple? If the money supply rises by 30% over the next couple of years, we should expect the S&P 500 to also rise by 30%. Unfortunately, it's not that simple. We can clearly see there are periods where the money supply is rising, but the stock market is falling. These are 50% declines in the stock market that we witnessed in 2001 and 2008, despite the money supply moving higher. The stock market swings up and down while the money supply stays steady. Sometimes stocks rise faster than the money supply, and sometimes they fall despite the fact that the money supply is rising. And we can see that very clearly by looking at the ratio of the S&P 500 relative to the money supply. This is what that ratio looks like. And you can see the S&P 500 hasn't gone up more than the money supply since 1968. But in the late 1990s, the S&P 500 went up a lot faster than the money supply because the economy was booming. In 2008, the S&P 500 went down relative to the money supply because we were experiencing a recession during that period. These swings in the S&P 500 can be in large part explained by how strong the American economy actually is. In the 1970s and 80s, the economy experienced many severe economic recession, and so the S&P 500 fell relative to the money supply. But when you look at what the actual stock market did in 1980, it was making new all-time highs. So it looked like the stock market was rising substantially in 1980, but when you adjust it for the money supply, the performance was very poor. This is what I would really classify as a reverse stock market crash. Today, that's not what seems to be happening. The S&P 500 is rising relative to the money supply, which looks a lot more like the 1990s period where the stock market was rising during a time of prosperity. In fact, the ratio currently sits at the same level it was during the period of extreme market speculation of the dot-com bubble. If we were to see the same move happen again today as what happened in the late 1990s, that would mean the S&P 500 rises by another 40% more than the money supply. This is what happens during recessions. The stock market falls relative to the total money supply. If we see this ratio come back to the level where it was in the 1970s and 80s, that would mean the S&P 500 falls by 60% relative to the money supply. The money supply typically doubles around every 10 years. And over the long run, the stock market follows the money supply. So the odds are, taking into account the swings up and down that we'll see along the way, we should expect the stock market to be higher in 10 years than it is today, regardless of how many recessions we see, which is why we're very keen on buying the right parts of the stock market at attractive prices at Game of Trades. We recently added a very interesting investment idea to our weekly asset ratings. You can check it out by signing up to our free trial.